So in the part one of this class, we were able to look at departmental accounting in terms of the accounts involved. We were able to define departmental accounting. We were able to look at the basis for apportioning expenses. We were able to explain how to prepare departmental trading profit and loss account. We showed you how or what it looks like, and then we also look at departmental balance sheet and how it looks like. We're going to explain interdepartmental transfers. Okay, so we were solving a question in the part one. So we're going to continue from where we stopped in the part one. So basically, we've started solving the question. So we've already looked at the question and the additional information. We are on the trading profit and loss. We've explained how we got turnover. We've explained how we got cost of goods sold. So we've already explained how we got the gross profit, okay, which is the difference between turnover for each unit minus the cost of goods sold for each unit. We also explain how we got the gross income, which is the gross profit plus other income. So we're going to continue from the expense aspect of the departmental trading profit and loss account. So let's continue. So we are on the total expense. So what's the total expense? What are the expenses here? So we have rent. What's the rent in the question? The rent in the question is 58,000. So how do we apportion? 3 years, say rent should be apportioned in the ratio of area occupied. So shoe here is 5 square meter. Glasses is 3 square meters. So how do you apportion 58,000 between the unit of shoes and unit of glasses? So what do? They've given us the square meters. Shoe here is 5, glasses 3. So 5 plus 3 is 8. So for shoe, we're going to say 5 divided by what? 8 multiplied by 58,000. Use your calculator. That will be 36,250. For glasses, we're going to say 3 divided by 8 multiplied by 58,000. That'll give us 21,750. That's how we got the apportionment. The next one there, after rent, we have warehouse. It's a direct apportionment. Shoes. So we just pick it directly. Warehouse expense under shoes, 25,000. The next one there, we have salaries and wages. Glasses is 32,000. Shoes, 28,500. So we can see salaries there under shoes, 32,000. Under glasses, 28,500. So if you add, you have 60,500. The next one, depreciation. They said depreciate equipment and motor vehicle by 20% straight line. So what is our motor vehicle in the question? 325,000. So what's 20% of 325,000? 65,000. And then they said we should share it. They say other expenses should be shared equally. I already explained how we treat depreciation in trading accounts. It's an expense, and then it will be taken out of your motor or out of the asset in the balance sheet. So already we know that 20% of motor vehicle, which is 325,000, is 65,000. If you divide it by 2, which is equally, shoes will take 32,500, glasses will take 32,500. The next one is equipment. Equipment in the question is 250,000. So what is the 20% of 250,000? That's 50,000. Okay, so basically if you divide it equally, you have shoes taking 25,000, glasses taking 25,000. So the next one is discount allowed. Discount allowed here is for only glasses, which is 25,000. So you have discount allowed 25,000 here. So basically, if you add all the shoes total expense, you have 157.50. All the glasses, you have 132.750. Total 283.500. So our expense in the trading account now, for shoes you have 157.50, glasses 132.750. Total is 283.500. So here's the point I'm trying to make in the reasons for preparing departmental account. You can see that in this trading account, shoes made a profit 18,853, but glasses, there's a loss of 79,853. So if you have done a combined position without separating it, you see that the business is making loss. But which unit is causing the loss? Is glasses, as you can see, 79,853. So shoes here is making profit of what? 18,853. So this is one of the reasons that you prepare departmental account. You tell the unit that is what? Performing. So here shoes is performing, glasses is what? Performing. So that's what you're going to say in your report basically. Then the next one is your preparation of what? Your balance sheet. Your balance sheet is the same way you prepare balance sheet. So what do? Stay on the financial position as at 31st March 2017. So what are your non-current assets? We go to what? Note what? 5. You have land and building. What land and building in the question? 240,000. Here it is. 240,000. Motor vehicle in the question is 325,000. But there's a depreciation of how much? 60,500. So 65,000, I beg your pardon. So motor vehicle is 325,000 minus 65,000. So what do you have there? You have 325,000 minus, but that's 260,000. So office equipment is 250,000 minus 50,000. That's the depreciation. So you have 200,000. So if you're adding everything, 240, 260, 240, you have 700,000. That's what you have here. Non-current asset, 700,000. Other assets according to the question is goodwill. Goodwill in the question is how much? 10,000. We didn't write it off. So goodwill remains 10,000 in the question. Then what else? You have current assets. What are your current assets? Cash at hand. What's your cash at hand in the question? So you go to the question and pick them and put them accordingly. Cash is 45,000. Your debtor here, 55,000. You can see debtor there. Then there is an accrued income. Remember, accrued income is an asset. You have earned it, but you have not received it. So the person that is to pay you is what? Is a debtor. So accrued income, 22,000 based on additional information. Accrued discount received here. That will be a current asset. So what are your closing stocks? Closing stock for shoe, 3,000. Glasses, 4,000. So we have shoe here, 3,000. Glasses, 4,000. That means we have 129,000. That's your current asset. Note 7. So when you add these two, you have 710,000. Current asset 129. Bring it down. This plus this is what? 839,000. So what are your long-term liabilities? The question, we have loan. You can actually have other items, but bank loan here is 600,000. That's what you have here. So you bring it here, your balance sheet, 600,000. What are your short-term liabilities in the question? What do you have? You have bank overdraft, 120,000. Bank overdraft, 120,000. That's what you have here. If you add the two, you have 720,000. So owner's equity. Remember I said your owner's equity is a function of your capital plus your what? Profit. If you made profit, then it is actually increasing your what? Equity. If you made loss, it will reduce your what? Equity. In this question, there is a loss. The business made a loss. Look at it. 61,000. So that will reduce the equity. What's the capital here? 180,000. So 180,000 minus the loss here, 61,000. That will be 119,000. Equity has reduced. So owner's equity here is 119,000. If you add it to your liabilities, you have 839,000. That is your what? Total liabilities equal to your total what? Assets. Agreeing. So we can simply say that your what? Assets has been financed by what? Your long-term liability, short-term liability, and the equity to be what? 839,000. Class, we've been able to prepare departmental trading profit and loss accounts. We're able to take into consideration transfers between units, and then we're able to explain. In fact, we also treated accruals, just like what we've done in other classes for accruals. We tested depreciation as well. So basically, that is it for preparing trading profit and loss account for departmental businesses or departmental stores. We also prepared the balance sheet. Okay, so if you have questions, you can reach me on 0813650636 or send me an email, jeremiah.doso@gmail.com. You can as well drop questions in the comment section. I'll be there to reply with the right answer. I have a Facebook page, Jeremiah Adira Doso, that's Jad. You can Like the page to get updates as we publish topical classes from time to time. Thank you.